Hi, I'm Lauren. Most businesses need funding at some point, whether you're launching a startup, expanding, going through a rough patch, or even selling your business. Without your financial records and taxes in order, navigating the world of business lending can be difficult. In this video, I'll break it down, what banks look for, the types of loans available, and how solid accounting and tax records make all the difference. Let's start with what lenders want to see. They will, of course, need details about why you need the loan. This shows the bank how you'll use the money and how you plan to repay it. Next, they'll ask for tax returns, typically the last 2 or 3 years for both you personally and your business. But tax returns alone are not sufficient for business lending. That's because tax returns typically end on December 31st of the prior year, and you may be seeking financing 6 months or a year later. So they do need more up-to-date records. That's where your accounting and bookkeeping comes in. They'll ask for bank statements, possibly personal financials, and at a minimum, they'll need your business profit and loss statement and balance sheet through the current period. Sometimes the financials also have to be signed off on by you and your accountant, and many lenders request income verification from your accounting firm. The bank will want to calculate your business debt service ratio, maybe the expense ratio, and allow for certain income add-backs such as bonus depreciation or related company transactions. They have to make sure that after adding the new debt to your business, you'll still have enough cash flow to make the repayments. Your credit score matters too. A strong personal credit score can help if your business credit is still developing. And don't forget collateral. For unsecured deals, anything you have of value like equipment, inventory, or receivables can sometimes be used to secure the loan. Taking on too much debt can also put a business out of business. Unlike personal mortgages, the repayment and refinancing terms of business loans can be more complex, especially for an inexperienced borrower. For instance, many business loans are amortized over 10 to 20 years, but have a balloon payment due at 5 or 10 years. And on top of that, there may be prepayment penalties if you try to pay it off early. Understanding these terms up front is critical to avoiding financial trouble down the road. There are a lot of different types of loan products, and they change based on the economy. Think about during the pandemic. There were many more business loans available than pre-pandemic. The banks or lender you work with will try to find which one is right for you. I can't cover all of them here, but it's important to understand at least the difference between SBA loans, traditional bank loans, and alternative financing. SBA loans are government-backed loans designed to help small businesses that might not qualify for traditional programs. They have microloans for smaller amounts under $50,000 or collateralized loans up to $5 million. Traditional bank loans offer term loans for big purchases or lines of credit for working capital. These are great for businesses with strong financials, often have lower interest rates, but can be harder to qualify for without a proven track record. Alternative financing should be a last resort. If you need cash quickly, online lenders, invoice factoring, bank statement loans, or merchant cash advances could be an option. But beware, these often come with extremely high interest rates or fees, so they're best for short-term fixes, not long-term financing. I almost never recommend these loans. Investor financing would be the other option. This is typically non-bank loans from a person, another business, or other business investors, but debt versus equity financing is key for businesses looking for fast growth or startups with acquisition goals. When you're thinking about taking on debt, think of us as your secret weapon. Accurate financial records and tax returns are crucial for getting a loan approved. You can cut through the red tape when you're able to provide a lender a clear picture of your revenue, expenses, assets, current debt, and profitability. Securing a business loan requires preparation, but it's exciting, giving you an opportunity to grow. Know what the bank needs and understand your options, and keep your financial records in good shape. If you ask any banker, they'll tell you it's a lot harder to secure financing without a secure accountant. Thanks for watching.